On March 1st, 2026, the Small Business Administration made a huge announcement that changed everything for small business loans. They dropped the requirement for lenders to use the FICO SBSS score for loan pre-screening. But here's the catch that nobody's telling you. Most banks still demand a minimum score of 155. If you're applying for a business loan right now, this affects you directly. Let me break this down. The FICO SBSS score is a specialized credit score for small businesses ranging from 0 to 300. It combines your personal credit history with your business credit data to predict loan repayment risk. For years, the SBA required lenders to use it for screening loans under $350,000. But as of March 2026, that requirement is gone. So why do lenders still care? Because the SBSS score gives them a quick, standardized way to assess risk. Banks have internal systems built around it, and changing those takes time. More importantly, data shows businesses with scores below 155 have significantly higher default rates. Lenders aren't going to ignore that just because the SBA says they can. Here's what you need to know. Your SBSS score is calculated from 5 key factors. 30% comes from your personal FICO score. Another 30% from business credit utilization. That's how much of your available credit you're using. 15% from trade experiences like payment history with suppliers. 15% from public records like liens or bankruptcies. And 10% from business size and age. If your score is below 155, don't panic. I'm going to give you 5 actionable strategies to boost it. First, focus on your personal credit. Since it makes up 30% of your SBSS score, getting your personal FICO above 700 can give you a massive lift. Pay down credit card balances, dispute errors on your report, and avoid new hard inquiries. Second, manage your business credit utilization. Keep it below 30%. If you have a business credit card with a $10,000 limit, don't carry more than $3,000 in balances. Pay early and often. Multiple payments per month can help lower your reported utilization. Third, build positive trade lines. Open accounts with net 30 terms with suppliers and pay them early. These get reported to business credit bureaus like Dun & Bradstreet. Just 5 to 10 positive trade lines can significantly improve your score over 6 to 12 months. Fourth, avoid public record negatives. This means no tax liens, judgments, or bankruptcies. If you have any, settle them immediately. A single public record item can drop your SBSS score by 50 points or more. Work with a professional if needed to negotiate removals. Fifth, demonstrate business stability. Lenders love to see time in business and consistent revenue. Even if you're a startup, establish your business legally with an EIN, business bank account, and proper licensing. Update your information regularly with credit bureaus. Now, here are 3 common mistakes that tank SBSS scores. 1, mixing personal and business expenses on the same credit card. 2, maxing out business credit lines right before applying for a loan. 3, ignoring business credit reports. Errors are common and you need to dispute them just like personal credit. So what's the bottom line? The SBA dropping the SBSS requirement doesn't mean you can ignore it. In 2026, lenders are still using it as a key filter. By focusing on these 5 strategies, you can get your score above 155 and dramatically improve your loan approval odds. It might take 3 to 6 months of consistent effort, but it's worth it. What's your biggest challenge with business credit right now? Drop a comment below. I read everyone and might feature your question in a future video. And if you found this helpful, hit that like button and subscribe for more actionable credit strategies.